Hey guys, how's it going? It's Andy from MagooInvesting. Welcome back. In today's video, I'm going to talk about some of the big news events that have happened this past weekend. Remember in the past couple videos how I talked about Monday mornings are when the market really reacts to what has happened over the weekend. In today's video, it was actually requested for me to talk about how the Federal Reserve is handling the current world economy and the problems that we're seeing in the United States. And so in today's video, I'm going to break down kind of what the Federal Reserve is, what their responsibilities are, and how they've acted in the past couple weeks to try to prevent an overall recession happening in the United States economy. Before we get started, I want to say happy birthday to my dad. He's been supporting me in my videos for the entirety that I've been making them, so happy birthday to you. So in this video, I wanted to break down how the Federal Reserve has been taking actions to try to save the overall United States economy. So what is the Federal Reserve? And it was created in 1913, and over the years they've expanded to become the central bank of the United States, and they have a lot of responsibilities when it comes to protecting the overall economy, and they're one of the main tools that we have to protect ourselves from recessions, inflation, and all these things. As I mentioned, over the years, their roles have expanded, and the two main times that they've expanded is during the Great Depression in the 30s and then the Great Recession of the early 2000s. And now as we head towards a potential recession as a result of coronavirus and the shutting down of the world economy, the Federal Reserve has been taking a lot of actions to try to prevent as much of the damage as they can. At this point, they've kind of used a lot of their tools. So in this video, I wanted to break down the two main ways that the Federal Reserve can try to limit the damage from a potential recession. In the past couple years, I've noticed that every time the Federal Reserve comes out, and the main thing that they've done in the past has been raising or cutting interest rates. And as that happens, the stock market has reacted to it a lot. In the past week, the Federal Reserve has cut interest rates down to pretty much zero. And so in this video, I wanted to talk about what that means for the world economy and some examples of when we've seen this in the past. At this point, the main reason why the Federal Reserve is cutting interest rates down to zero is the fact that businesses are struggling. If you've been looking at the news or if you're just living right now, you've noticed that pretty much everyone has been told to shelter in place. My family lives in California, they're in shelter in place. I'm up in Oregon, we're pretty much in shelter in place, and a lot of non-essential businesses are being shut down. At this point, the US economy is really struggling because people have money to spend. We just came out of the longest bull market in history. The economy had been going pretty good. But at this point, people are scared about the future and there's not a lot of places to spend their money. So cutting interest rates down to zero means that for businesses, they can borrow pretty much as much money as they need with having really low interest rates. So the cost of borrowing is really low, and it's trying to boost the overall economy. It's making it so saving is less attractive, so the consumers are trying to be pushed towards spending more money to boost the economy, and it's making it easier for businesses to borrow money to support their businesses during this tough time. As someone that's only really been paying attention to the stock market for around 5 years, I kind of wanted to look to see what the history of the Federal Reserve benchmark interest rates have been over the past 50 or 60 years. And when I put up the all-time chart, you can see the incredible range of interest rates we've seen. And the one area that should pop out immediately is in the early 80s, when interest rates hit around 20%. The reason I bring this up is that having lower interest rates overall increases the risk of inflation because there's more money being transferred and it pushes the inflation rate up. In the early 80s, this spike in interest rates is a way for the Federal Reserve to combat inflation overall. And during this time, we had stagflation, which is a topic that I mentioned in the past video, just because I thought it was a really funky term. Stagflation is usually characterized by high unemployment and high inflation. And during this time, this was the case for the United States in the 80s and across the world. And one of the ways that the Federal Reserve can try to combat this is by spiking interest rates. And when this happens, it makes it more expensive to borrow money, cash isn't being exchanged as much, and there's incredible benefits to saving money. And so when less money is transferred back and forth, inflation rates drop. And so this was the tool that they used to try to combat this. This goes with the overall kind of responsibility of the Federal Reserve as they're trying to stabilize the US economy and keep things relatively calm and try to minimize any potential damages from an economic downturn. And so now as we get to this point, we're kind of on the opposite spectrum as we were in the 80s. Inflation rates are pretty much zero. It's not the problem of inflation is spiking, it's the fact that people aren't going to be spending as much money because all these businesses are closed. And so for someone like myself, what does pretty much zero interest rate mean for us? And for people that aren't in businesses, it means that saving money is not as beneficial anymore. As interest rates plummet, the amount of money you're making from interest and stuff like banks and bonds is really low. And so as inflation stays around 3%, if you have your money sitting in a bank over time, it's actually going to be depreciating in value. And so this is the Federal Reserve trying to push people towards spending money. So while it seems like a good idea to be saving money right now, the amount of money you're going to be making from interest is going to be a lot lower than it's been in the past. So it's trying to push people to spend more money. The last time interest rates were this low was after the financial crisis of around 2007, 2009. That's when they were pretty much at zero. Prior to the crisis of 2007, interest rates were around 5%. So cutting it down to pretty much zero was a huge change in the overall financial policy of the United States. And it was a big move, and it helped get us out of that really tough time. However, going into the current state of the world with coronavirus, interest rates were only around 2%. So the amount of power that the Federal Reserve had to try to protect the economy was not as much. In the past couple years, there's been a lot of talk about the Federal Reserve should be pushing up interest rates to allow themselves to protect us if the economy starts to slide. And as it rapidly did, they had to quickly change from around 2% to cutting it to pretty much zero. And that's kind of limited the amount of overall effective response that they've had to this crisis. And that's why when the Federal Reserve came out and said that they were cutting rates to zero, it spiked the market for a little bit and then overall continued to slide because the market did not think that that was enough of a move to slow the damage of what we're seeing right now. So as I mentioned, we pretty much cannot go any lower with interest rates. There's been some calls for negative interest rates, meaning that the Federal Reserve would be paying you to borrow money. You've seen it in Europe and Japan, but there's a lot of mixed reviews on whether or not that's actually possible, and I don't think we're actually going to see that. So the two main ways that they can try to boost the economy and stabilize the market is with interest rates, and the other one is with open market operations, or OMOs. OMOs are the Federal Reserve buying back any security on the open market, and it's in a way to try to boost the overall economy. The big news from today is the fact that the Federal Reserve is coming out and saying that they're going to buy as many bonds for the United States as possible to try to stabilize the overall economy. This comes after 3 different times that they've come out and saying that they're going to be putting all this money into the economy to try to stabilize things. And pretty much saying that they're going to be writing empty checks to try to stabilize the economy is an unprecedented move. This tactic goes along with quantitative easing, or QE, the idea that the Federal Reserve is pushing money into the economy to try to slow the damage. And as interest rates are pretty much zero, this is the main way that they can try to combat what we're seeing right now. So when the market opened this morning, things were green for a little bit because the market took this as a good sign that the Federal Reserve is trying to do as much as they can to help the economy, help all these corporations. But now as the day continues to go on, as we've seen in the past, it goes green for a little bit and then it starts to slide. And so it doesn't look like it's going to be enough to stop the damage right now, but it should be enough to kind of put a band-aid over this large cut in the economy. Right now, it seems like all eyes are on Washington as the $2 trillion stimulus bill failed to go through this past weekend. I don't want to talk about the politics about it at all, but the main reason for the stimulus bill is to give money to average Americans and to bail out major corporations. And that's where a lot of people have some very strong opinions on if the United States government should be trying to bail out these companies. And one of the big sectors involved in this are the airline stocks. I've been very vocal in the past couple weeks talking about when I mentioned cruise ships and why I think they could be a great opportunity in the future, and I talked really poorly about airline stocks. And now, as we're about a month into this overall crisis, the airlines are coming out and saying that they're going to need to be bailed out. And that's brought up a lot of, I think, very valid points about how we're a month in and they already need help after the longest bull market in history. So I'm going to try to make this not political at all and just kind of give you the two different sides of the argument right now. One of the sides to potentially bailing them out is that it's a source of a lot of United States jobs. And so not bailing them out, they're going to have to cut a lot of the workforce and it's going to hurt the overall economy as well. And so that's the push towards that. And the push towards not bailing them out is the fact that back in 2009, they had to get bailed out. They've had a very rough time in the past of needing plenty of bailouts, companies going bankrupt, a lot of mergers. I talked in the cruise ship video about the graphic where it showed all of these airlines back in the early 2000s and how they've merged into 4 or 5 major corporations at this point. The other major argument for not bailing them out is the fact that 96% of their free cash flow over the past decade has gone to stock buybacks. This is a topic that I have not discussed on this channel up until this point. So stock buybacks is basically when a company uses their free cash flow to buy shares of their own company from the open market. What this does is it limits the amount of outstanding shares for the company overall in the open market. It also makes it so that one share now is worth more because there's less overall shares. So each person gets a boost in the overall ownership of the company. And basically what this does in the short term is it pushes the overall share price up. People have some very strong opinions on the ethical reasons for why companies are doing stock buybacks, and it mainly has to do with pushing the stock price up to make it so that the executives get a higher bonus at the end of the year. And so there's a lot of opinions on that. But the major topic of discussion right now is, should these airlines and other corporations that need it, should they be bailed out? We're a month into this really crazy time in the world, and there's a lot of varying opinions on that. And so I'm going to leave it at that. It's a very political topic, and I don't want it to get to that point on this channel. So if I do see any very politically charged comments in the discussion below, I will be removing them to try to make this a civil discussion about the stock market, investing, and the main topic about the Federal Reserve. At this point, let me know what topics you'd like me to go over in a future video. This is kind of a change from what I've been doing in the past, really focusing on the stock market, but with the request for this video for the Federal Reserve and the need for having a better understanding of how the Federal Reserve impacts the overall stock market and economy, I thought this was a good topic to go over and discuss. So let me know what you thought about my kind of analysis of what the Federal Reserve has done, what they've done in the past, and kind of the tools that they have at their disposal to try to boost the economy and stabilize the overall stock market. So let me know in the comment section down below, and let me know what topics you'd like me to see in a future video. Thanks for watching. Be sure to stay inside, and I'll see you in the next episode. Thanks for watching.